So let's have a chat like we are having a chat now and just talk about things. This is now coming to the end of the year. So much has happened this year, 2025. Woo! It's been a big year.
It's been a massive year, right? I don't know how much. Yeah, actually, we've talked about this before, Mish. You're a little bit woo-woo. It's been year of the snake. It's been, in numerology, it's a 9 year. So this year was all about, shedding and new identities and clearing the slate. And I don't know about you, but every single person in my world has just completely ripped apart businesses in investment strategies, jobs, where they live, all sorts. There's just been so much of clearing the slate and changing and getting ready to get into a new year next year.
100%. I was speaking to some working colleagues the other day, and they were saying exactly the same thing. We were talking about Year of the Snake. I didn't know that it was the year 9, which means that next year is year 1. And
correct.
It's the year of the horse, isn't it?
That's right. So with the snake obviously is shedding. A 9 year is all around completion and endings, and the 1 year is all about the new beginning of the next cycle. The next 9 year cycle. And obviously the horse is fast moving. I've got a funny feeling that there's going to be a lot of changes next year.
I think you're 100% right. I'm not even going to start predicting where those changes are.
Good idea, I reckon.
I've got a damn good idea. I follow quite a lot of economists and speculators and that kind of stuff. So I get a good kind of, rounding opinion, let's call it, from everybody else. But I don't like to throw any opinions out there for myself. So we just keep it open. But yeah, sure. This most certainly has been Year of the Snake, the year of shedding, moving on, making changes. So, you know what? We now at the end of the year, and it's time to just let go.
I was going to say, take a breath.
Take a breath, man. Absolutely. Take a breath, take a break. Everybody I know is like just starting to wind down. And we're going to be joining them too.
Absolutely. I'm quite looking forward to I don't drink a lot, but I'm quite looking forward to having a cocktail by the pool and doing not much. But also I think it's a really great time of the year because you have slowed down. Most of us take some sort of time off from jobs or business. It's a great time to chill. And that's when the brain starts to think, well, what do I want for the next year? How do I want 2026 to look different? Maybe what do I want for the next 5 years, 10 years? And it's the time that you have space in your brain to dream and think through what that looks like. So I think it's a really great time of the year to talk about what this investment strategy could look like as a long-term strategy. And I know it's always long-term, Mish, but sort of from that first purchase to having that income replacement and what that could look like.
I think it's, this time of the year, I find a lot of people reach out to us because they're on holiday. They've now got the time. They start looking at commercial real estate. They think, oh, I wonder what I can afford. And they think, oh, let's see who's got what, who's offering what. So they reach out to have these conversations about growing their income or perhaps purchasing income generating or starting income generating portfolio or transiting from residential into commercial and wanting to scale their investments or replace their income, those sort of things. I find sometimes it can be a very busy time for me. But just to let you guys know, this time I'm actually going back home. We've got a wedding on in South Africa, so I'm going to be switching off for a couple of weeks. But welcome your calls in January.
I love weddings. That sounds so exciting.
Yeah.
I was going to say, for anyone that hasn't listened to our episodes, I just want to pre-frame this. It's almost like the Beauty and the Geek but it's the expert and the person who's got no idea. With Mish being the expert here and me having no idea about commercial investment, I was going to say the dummy, but I'm not a dummy. I just don't know about commercial investment.
Yeah.
Exactly. So for anyone that hasn't heard this before, don't expect me to come out with any wise tips. This is all Mish's area, and I'm here to, I guess, ask the questions that maybe other people like me are thinking. Because if I've got no idea and I have that question, then maybe someone else will.
Yeah.
So I just wanted to pre-frame that, Mish.
Thanks, Sam. I think that's a good thing to mention. And just for those who don't know, we offer a Q&A session as well. So a lot of these questions come out of that Q&A. So these questions are often your questions, the audience's questions, asking these type of questions. And it might not be all in one session. It might be, over the course of a year. And it's great to have the opportunity to talk about these things, because for me, I don't walk around thinking to myself, gee, what are people asking, until people actually ask it, that we can talk about it. So we've just highlighted a couple of pointers that hopefully are going to help people out today. And that's exactly what this podcast is all about, sharing as much information as possible. On that note, just a little sidebar. I was speaking to somebody. I had a lunch with somebody this week. He's a big time investor. In fact, he pipped me to the post. We made an offer on a property, $15.5 million property, and somebody came in with a cash offer and bought the property for $16 million cash. And I was like, wow, how did that happen? Seriously, it just came in and boom, and the deal was done and we lost the deal.
Yeah, I bet it was. And I would take that deal too.
Yeah, and I was a little bit shocked by it. Anyway, it turns out that I was sitting next to the guy who bought it for $16 million, the cash buyer. Yeah. He was at the lunch table with me right next to me, and I got introduced to him.
No way.
Lovely guy, really lovely guy. Anyway, and we had a good old chat, and I said to him, I'd really like to interview him. And he said, he doesn't really like talking. He's got a bit of an accent. And he said, but everybody's going to steal my ideas. I said, mate, it doesn't matter. You can talk about this as much as you like.
I was going to say there'll be plenty to go around, I would have thought.
Yes, yeah, absolutely. So I'm hoping to get him on the show sometime in the future. I think that will.
Wow. Yeah. Exciting. I'll definitely be keeping an ear out for that one.
Yeah, yeah.
Well, we are talking about from the first purchase to income replacement. So, Mish, I'd love you to start off by sharing, I guess, the strategy to move past the very first one, or even, how to get into the first one. Where do you want to start with this topic? Because,
well, look, I think
square one, right?
Yeah, square one. So, like I said earlier, a lot of people come through from residential into commercial. And I think the big thing to think about is don't just stop at one property. Purchase one property, feel it out, sound it out. Depending on where your risk appetite is, one property is great. But if you really want to build wealth, you want to scale your portfolio. You want to add a couple of properties into that portfolio over a period of time, because one property is not really going to give you enough cash flow, depending on the size of the property. If it's a $15 million property, then yes, it might be for a period of time. But even your purchasers who are buying properties in that $15 million bracket are scaling their portfolios. So irrespective of whether you're buying a property for $1 million or 15 million, the strategy is still the same. That you want passive income, and you want to be adding a second and a third and a fourth, and you want to create a portfolio. It's not just a one, what do they call it? A one pony magic stream.
Was it a one trick pony or one
pony? There we go.
I've got a question for you, Mish.
Yes.
Knowing that you're going to scale, if that's the strategy, does that change what that first property looks like? Like, do you need to know what the strategy looks like scaling before you choose the first one? Does it make any difference?
It's a great question. That is a great question. And a lot of people ask me that when we start. Now, there's often quite a lot of apprehension to purchasing a larger property when somebody comes in. So for argument's sake, if somebody comes in with $2 million, and I'm going to say to them, look, they can afford a property of between $4 to $5 million. Now, the difference is they might want to buy a property of $2 million in cash versus a $5 million property that you're leveraging against. Now, I always say to them, think about it this way. A $2 million property could give you an income of about $120,000, whereas a $5 million property is going to give you an income of around about $350,000. And I'm using a basic number at around about 6% yield, round figures. So how hard do you want your money to be working for you? My strategy would be to buy as big and bold as possible for the first time round, because you are going to ultimately, within 12 months, you're wanting to leverage off that property that you've purchased to buy your second and your third. And you can leverage your portfolio a lot faster with a bigger chunk of cash than what you can with little bits.
Mm.
So we're going to go through leveraging a little bit later, but and I'll show you the principles and the leveraging strategy there. So as opposed to going out and loaning or doing an equity drawdown of 100,000, which is not going to give you very much, you could be drawing down $500,000, which can get you into another very decent property of 1.2 million or something.
I'm a very visual person, and I imagine this, like when I think about investing, it's a snowball, right? We all know that it exponentially gets bigger. And I think it's like if you start with the bigger snowball, it's going to grow bigger faster than if you buy a little tiny snowball.
Yes. Well, you could end up with a lot of tiny snowballs that don't really kind of fit together. Whereas you really want to go into one good solid snowball and grow, and build on that.
Yeah.
So if that makes sense.
Yeah. Sorry, I took you down the snowball route.
Yeah. You did too.
It's Christmas time. I'm thinking about, like snowmen. Like,
Hell, Sam, I don't know where you're going to find snowmen in Australia.
Certainly not here right now when we're recording.
No, but it's a mindset and it's a strategy. So when we have a one-on-one session with the clients, we speak to them about that strategy and that mindset, and we explain the difference between bulk versus just little bites. And a lot of people just want to go for the little bites at first. There's nothing wrong with it. It's just a slower strategy.
Yeah, totally. Now, before we started recording this episode, I did ask you a question that did make me feel a little bit like a dummy. So I'm going to ask it now. And I hope that I'm not the only one that doesn't know this. You were talking about cash on cash returns. I actually don't know what this means. Can you explain it? Because I think this comes in somewhere around here.
Yes. So look, it's quite simple. The cash on cash is the percentage of your initial investment that you're earning in cash flow every year, okay? Which means that it's just a measure of your earnings in relation to the money that you've invested. So, for example, if you've bought a property, let's just simplify the numbers for the exercise. If you bought a property of 500,000 and the annual rental is 40,000, then your cash flow investment, including the deposit and transactions, your transactional cost, was 100,000. Your cash on cash return would be 40%. Okay, so 40% divided by 100,000. So it really is looking at the solid return. It's how your portfolio grows. We call it the COC, cash on cash. You want that to stay consistent, meaning that it's always earning a good return on your property and it's helping you scale the portfolio. Does that make sense?
It's getting there.
Okay. We'll put those numbers in the notes. So if people want to understand it a little bit better, sometimes just talking about the numbers can be a little bit complicated. So you buy the property for 500,000, you've effectively spent 400,000 on it, you've got 100,000 over. So that's your cash on cash.
Okay. And that needs to stay consistent. So how often do you look at those numbers?
Look, you want to look at those numbers every time you are buying a property so that you know what your cash on cash is. However, there's a lot of other factors that are going to affect your acquisition, your yield, your market growth, the capital growth, whether it's an uplift property, whether there's a lot of factors in your numbers that you need to take into consideration. So this is just one of the many spreadsheets and numbers that you need to take into consideration when buying a commercial property.
Mm-hmm.
Yeah, it's just a little bit of information managing the finances and the money when purchasing that commercial property.
So you said then just a little bit of information, but I think that the more information you get around this and the more you understand it, it's not just a little bit. It can be a huge difference between really paying attention and being.
Look, it's Sam, it's all about articulating the numbers. It's about looking at a deal and saying, is this the right deal for me? Because bearing in mind, when you're purchasing commercial, you're looking at a long-term acquisition and you're looking at the numbers. You're looking purely at the numbers when purchasing commercial. And the biggest question is this going to pay me over time? And what is it going to pay me? So that's why you're going to be looking at your cash on cash return. You're going to be looking at your yield. You're going to be looking at your capitalization rate, your cap rate. We've spoken about that a couple of times before. And is it putting money in your pocket or is it taking money out of your pocket is the biggest question.
Yeah, and you need to know that, right?
Yes, absolutely.
Internal rate of return. This is something else that is really important. Can you talk about this?
Yeah, so we call this the IRR. Generally done on your larger acquisitions, not really on your smaller investments. We look at your internal rate of return on a $10 million plus sort of acquisitions. The simple measure for it is the overall return that you can expect to invest on the investment, factoring all the costs over a period of time. Okay, so it takes into account your cash flow from the rent and from your capital appreciation of that property. So I mentioned earlier that you've got a capital appreciation and you've also got the property appreciation. So as the area grows, and the capital appreciation is whatever you do to the property improvements. This helps you understand the growth of the investment long term. And that's why I say it's very much a larger scale sort of calculation that you would do, but it is still important that you know. Okay. So as part of scaling your portfolio, it's not just about the cash flow, it's about the property and the value of the growth of the property as well. Okay, so when you're combining your cash flow with the capital growth as well as the market growth, so this is where you get a difference. And a lot of people don't understand the capital growth versus the market growth. Market growth is what you get in residential property. It's as the market grows, your property values up in price, increases in price. Your capital growth is what you do to the property, your rental, your tenants, how you tweak that. Your leases, let's say you're going to get capital growth out of that. And that will give you the true picture of how your investment is improving and performing. Okay. So with all of that together, your IRR is going to give you, as part of scaling your portfolio, it's not just about the cash flow, it's about the property and the value of the growth of the property as well. Okay. So when you're combining your cash flow with the capital growth as well as the market growth. So this is where you get a difference. And a lot of people don't understand the capital growth versus the market growth. Market growth is what you get in residential property. It's as the market grows, your property values up in price, increases in price. Your capital growth is what you do to the property, your rental, your tenants, how you tweak that, your leases, let's say you're going to get capital growth out of that. And that will give you the true picture of how your investment is improving and performing. So to do an IRR on a property worth about $1 million would take a good couple of hours, and it's quite an expense. We do we brush over it lightly and have a look at where market trends and that sort of thing. So it's not really in depth, but that's why I say the IRR is very much for your sophisticated investors that are buying larger investments. Still, for a small investor, if you're a numbers person, well worth looking into this. We'll help you out with the data. Have a look at it. And for those people that are numbers people, this is great for them to work on. So yes, we do help them out, but not in that detail.
Yeah, cool.
Yeah.
Let's talk about equity and leverage, because this obviously is absolutely what's needed to be able to scale. I also know that I'm asking you a massive question because, it's like, how long is a piece of string? But what can you share about equity and leverage?
Look, this is one of my favorite topics all around. Seeing that we were just talking about cash flow and IRR, this is exactly what it's all about. So what you and building that portfolio, what you're really doing with leveraging is you're wanting to purchase your first property where you can do an equity drawdown within a period of time. That might be 12 months, it might be 24 months, not sure, depending on the property and what you're doing with the property. But let's just drill down into what exactly it means for those listeners who don't know what leverage is and drawing equity would be. So let's just put it into numbers, for instance. Again, let's say your property is 500,000. I'm using it as a simple little round figure. And within 1 year, it goes up to 600,000. You've gained 100,000 in equity. Mm-hmm. So the equity is not cash in your hand. It's the value of the property. Okay, but it does mean that you can leverage that equity. And what do I mean by that? You can draw down that equity. Obviously, you're going to have the property refinanced, a new valuation. Valuer says, yep, it's gone up by 600,000. You now have access to $100,000. Okay. Mm-hmm. And let's say, for argument's sake, over that year, you have saved, or you've got 2 or 3 or 4 properties and you've got $100,000 in each one of them. You can leverage that capital, put it into one fund and buy one very nice commercial property or a new asset. Mm-hmm. Okay. Mm-hmm. So it's very much a matter of using other people's money, actually. So scaling your portfolio by leveraging the value of those properties. And I say using other people's money because you're leveraging that capital, which is very common in commercial, to buy another asset, to start purchasing your second and your third. And that's really how people grow their portfolios very fast. It's quite aggressive in strategy. Mm-hmm. You can be aggressive. You can do this every 6 months or every 12 months, depending on the asset that you're buying. And that's the way that you will scale your portfolio very, very fast. Okay. Mm-hmm. So it's basically using the collateral. You're borrowing that money. And that's why I say it's other people's money, because it's borrowed money. To purchase your second or your third property. And your power is in leveraging those funds, balancing out, make sure that you're not over leveraging, make sure that the market is right for it, and that you're leveraging correctly with the right lenders so that you can build your portfolio a little bit faster.
You answered my question before I could even ask it, because I was going to ask, how do you balance it? What do you need to pay attention to so that you don't over leverage?
Yeah.
So is there anything else that you need to add there, or
Yeah, I think it's very much a personal thing. It would vary from person to person depending on your risk profile. I've worked with people before that have got very, very high risk profiles, and they've leveraged within 6 to 8 months and built a $10 million portfolio over a very short period of time, 3 to 4 years. But it's very high risk. They're in business. They have the ability to pull money from other businesses and put it in real estate. And in my opinion, that really is the way to go. However, if you're not in that position, then you need to just have a look at your portfolio and see what is comfortable for you. And I always say, push yourself a little bit further out of your comfort zone, because if you stay in your comfort zone, you're not really going to get that growth. You're just going to stay on a little bit of a plateau. If you push yourself just a little bit beyond that comfort zone, you find that you will make it happen.
Mm-hmm.
And that will help you leverage your portfolio a little bit faster.
Yeah, totally. Um, I want to know, we're talking about leverage there
Yeah.
and scale. Does that give you an opportunity to diversify? Because, I hear a lot about diversification is much better in investments. I happen to know through something really bad that happened that diversification is really good. It's something that I didn't do.
Yeah.
Um, so it's always top of mind for me now. Like using those strategies, will that mean that you're able to diversify faster?
Definitely, most definitely. And depending again on the type of asset that you're buying, you really do want to diversify your portfolio. And we've spoken quite a lot about this, about spreading your risks across various different areas, various different types of assets. So, if you're buying retail, then buy some industrial. It's always nice to have a little mix of office. I know office is a little bit of a swear word. People still don't want office, but there's some very good things that are happening in the office space at the moment, actually.
Okay.
There's medical, there's childcare,
Mm.
there's fuel, there's service stations. So depending on who you are and what your portfolio is, I would say definitely you want to diversify, because if one sector takes a pounding, then at least you've got a couple of other sectors to carry you.
Yeah.
Likewise with area, you know.
Mm-hmm.
The fantastic thing about this whole strategy, and I've got a bit of a love-hate relationship with purchasing properties across borders,
Uh-huh.
states,
Yes.
but it definitely is a very good idea to have properties in other states, different types of properties, so that you're putting all your eggs in one basket.
Totally.
And diversification is all about stability and security.
Mm.
It's like an investment portfolio. You build up a diverse portfolio in investment, exactly the same as what you do in property investment. It's the same thing.
Mm.
So,
Yes. I love it.